No investor can ignore all the sound and fury over the fiscal cliff. After all, the nonpartisan Congressional Budget Office has warned at least twice that going over the cliff would trigger an economic recession. Tonight's market monitor, though, is keeping the long term in mind. Eric Ristobin back with us, Chief Investment Strategist at Russell Investments, tonight from Seattle. Eric, how much of a risk, though, does the fiscal cliff present for long-term investors in the short term?
Well, I think the biggest risk is actually trying to time clarity. I think a lot of people have been saying that they're going to wait until things are clear to enter into the marketplace. They're going to wait until all the bad news out of the system. As we know, that generally opens you up to the biggest mistake of either buying too high or obviously selling too low. So I think the biggest threat is trying to actually be really active in this period. I think having a long-term strategy and a commitment to equities makes the most sense.
Now, we know that in the long term, the markets are going to reflect corporate profits and corporate earnings. But isn't the fiscal cliff a threat to corporate profits?
Oh, it absolutely is. I think if you look at what we expect and what the broader market expects is we expect not to go over the fiscal cliff because we agree with the CBO that if we do, we go into a recession. We think that that's arithmetic and Congress can do arithmetic.
Okay.
So we're pretty sure it'll be an ugly debate, but we won't go over the cliff.
You are playing a little bit defensive here with some new picks, including a giant multinational healthcare company in pharmaceuticals, Pfizer, PFE. The stock here in the mid $20 range, off its high, but still has been trending nicely in the last 12 months. What do you expect out of Pfizer?
Yeah, we expect them to continue to move forward. All things being equal, Obamacare is probably good for pharmaceuticals. The more insured people, probably good for pharmaceuticals. We also think that of the kind of defensive sectors, healthcare is the most attractively priced.
All right. You're also looking at consumer stocks in media. Time Warner. Interesting choice here. It's rallied nicely from the summertime lows, but listen, you know where consumers' attitudes are. Job growth is meager, wage growth is non-existent, and those cable bills continue to climb.
Well, a couple of things about that. First, consumer sentiment is actually at a high point. So the consumer, I think, is actually probably be more willing to spend money now. The funny thing about cable is it oftentimes acts like a utility. If you think about, one of the last things people do in a recession or economic hardship is they turn off the cable. I think power and water are next.
So Time Warner, TWX, what do you expect here out of this stock in the next, say, 12 to 24 months as that long-term horizon out there?
Well, again, our views are for the broad market is that we're going to see kind of high single-digit returns out of the equity markets over the next 12 months. Time Warner is an overweight in our portfolio. We expect a little bit more than that.
You also like eBay in this regard. So, consumers looking for a deal out there as well on the auction sites. And again, one that's had a nice rally. No concern that perhaps it could be richly valued?
No, I think that there's been so much concern over the ability of the consumer to spend and continue to increase their spending, albeit at an extraordinarily modest pace. We think the economic recovery continues and that people are going to continue to spend money. eBay's well positioned within their market as a leader in their market. We think market leaders in areas where people are going to spend money are well positioned and good stocks to buy.
You have a rare sunny day today in Seattle in the Pacific Northwest. Last time we saw you, the sun was out back in May in the springtime. Comcast was the big winner since then, one of your choices, up 22.6%, but Microsoft and JP Morgan Chase both lower. Do you still like this trio?
Well, JP Morgan's interesting. We talked, I think, in mid-May last year, and almost immediately following our conversation, you saw the trading losses reported by JP Morgan. Our managers have their position in JP Morgan. We still own the stock, but at a much lower weight.
You own everything that we mentioned tonight, Eric?
And through our funds, and which are my investments.
Friday Market Monitor from Seattle tonight, Eric Ristobin, Russell Investments.